So why is it as a loan originator working for a mortgage broker, do we have to eat any kind of EPO or EPD when our borrower decides to pay off the mortgage or refinance or default within the first 6 months? Well, we're going to be having a live coaching call this Wednesday, and we're going to go into detail. But I wanted to share with you all today a little bit about what EPOs are. That's early payoffs, and EPD, which is an early payment default, and why we have to eat those costs when they do that within the first 6 months. First and foremost, we can't pass it on because the lender has an obligation to be transparent and follow all consumer protection guidelines. So when you are disclosing the terms of a mortgage agreement, you would need to include potential penalties, and imposing additional fees after the fact that could be viewed as unfair or deceptive. Dodd-Frank implemented that there's no prepayment penalties, which is both true and false. Dodd-Frank isn't saying prepayment penalties can't be charged on prime loans. They're saying that there has to be a really good reason for it. So you would think that lenders could have some sort of disclosure that the borrower pays to say that if you pay off your loan within the first 6 months, you have to pay back all lender fees. But unfortunately, we also have state regulations that come into play, and that makes it a gray area. So it's not necessarily Dodd-Frank that's saying prepayment penalties and EPOs are the same. It's really a gray area in the law, and it's got to be regulated and implemented through different government agencies. So, regulatory compliance. Well, consumer protection laws and regulations are often going to dictate what fees and penalties lenders actually can charge. So the lenders have to adhere to those regulations to ensure fair and responsible lending practices. Now, it's also up to the lender to do risk mitigation. That's basically underwriting, but if an underwriter sees something, they have to escalate it, and you've heard of SARs and things like that, where they're trying to make sure that there's no concern for early payment defaults. We, as a mortgage broker or a loan originator, actually may have an insight as to whether an EPO actually could happen. Now, in a falling interest rate market, we are at a higher risk for EPOs if our borrowers do not come back to us for the refinance where we can make it up. And then there's contractual agreements. So the contractual agreements are the terms of the mortgage agreement, including any penalties, and they have to be part of that contractual relationship between the borrower and the lender. So modifying any of these terms after the agreement has been made could actually be legally challenging and may not align with the established lending practices. So if your broker has already signed an agreement with the lender saying that, yes, they're willing to take the risk if the borrower pays off the loan before 6 or 8 months in some cases, we can't go and change that disclosure to pass it on to the borrower. It would actually have to be disclosed to the borrower upfront when all the other disclosures are coming out. And again, it's a gray area. Is it a prepayment penalty? Will the state that you're working in allow you to do that? So it's such a gray area, and I've spoken to the OCC, the CFPB, I've spoken to NMLS, and nobody really can answer if we could legally have a contract with our borrowers. Everybody says the place to start is with the lender, and the lenders, generally speaking, are not going to be willing to pass this cost on to the borrower. So, how do we protect ourselves as loan originators when we work for a mortgage broker? We can take several measures that are going to help avoid those early payoff penalties. Early payment defaults, well, you're going to need to foster a really positive and sustainable lending relationship with your borrower. For example, if your borrower tells you that they're going to be paying the loan off in under 6 months, then you don't want to be going lender paid. Any commissions that we get from the lender, any closing fees that are paid by the lender, we got to give that all back as a mortgage broker. So we're really leaving ourselves wide open to not only having to give back our commissions, but our brokers have to also give back any closing fees that may have been covered by lender credits. So if you have that conversation with your borrower and you explain to them about EPOs, which you certainly are permitted to do, you can do borrower paid. But if you do borrower paid, do not do that with any lender credits. You can do it with seller credits. Sellers and borrowers can pay for the closing costs and the points. But once the lender has any kind of credit or they're paying our commission, they have the right to ask for all of that back. So have conversations with your borrowers, disclose that you have EPO agreements, and make sure the borrower is willing to work with you. Okay, otherwise you are putting your commissions at risk, and all that hard work that you've put into taking a mortgage application and holding a hand. And sometimes we work with our borrowers for months before they get that house. We want to protect your commission. So make sure you know the rules of your state and what your rights are. For more information, CrimeMath Financial Learning Center offers a 7-day free trial membership. So you can come in, use our mortgage support rooms. They're open 5 days a week. Take some of our self-paced module trainings and attend our live coaching calls. Have a great day.